Hello, everybody, and welcome to the False Prophets Podcast. My name is Vinny. I'm your teacher, and today our subject is going to be subject to financing. That's probably going to be a three-part series, maybe four, maybe five, maybe two, who knows, but it's going to be more than one, okay? Um, and what we're going to talk about is, in this video, is basically what is it? I'm going to give you a 30,000-foot overview, going to get in a little bit of details about it. I'm going to let you know right off the get-go, this is not, repeat, not my favorite way of doing business, okay? And anybody who wants to go out there and try this, good luck, okay? Let me just tell you a little bit about my students. Some of my students, I'll say about a third of them, they want to be wholesalers. You know, they come in, they want to be a wholesaler, right? Let me flip a few properties, put some money in my pocket, then I'll go, well, obviously, let me wholesale a few properties, right? Put that cash in my pocket, then I'll go flip a few properties, and then after that, I'll be living on Financial Freedom Island. So, okay, so after their dreams are busted, right, you know, I got to sit them down and teach them, and, you know, they're happy now. Then my next group of people are the ones that want to do subject to financing. You know, good luck with those, right? Most of those have already wasted thousands of dollars and have been rejected and hung up on 10,000 times, and they're ready to give up and ready to quit, okay? The same with the lease purchase option people, okay? So, but have no fear, we have other methods, but I'm going to save you from spending a shit ton of money on the gurus for this stupid way of trying to do business. Now, can you do subject to financing out there in the real world? Yeah, you can. You can. Are you going to be able to do it with no money, no job, no credit? No. No, you might get lucky and do one. Maybe in a miracle you do two. But is two properties going to change your life? Now, in some situations, it will. Without question. If you're making $500 a month and you got two of them, you got 1,000, could be all the money in the world. I am not disputing that. I'm talking about true life-changing living in Financial Freedom Island, being able to come and go as you please. Right? What's financial freedom? Doing what you want, when you want, where you want, who you want to do it with. That's financial freedom. And I don't think like making $1,000 a month is really going to do that. But can you do subject to financing? Yeah. If you have money and credit and a job and can refinance homes and not worry about certain landmines, yeah, go ahead and do it. No problem. Go ahead. Right? But most of the people that want to do subject to financing or any type of creative financing are the ones that really don't have a lot of money. Right? Or don't have credit, or don't have a job. They're just trying to do some type of real estate to make money, get out of their rat hole job, right? Or get out of the hole that they're living in. We want more time, because time is more precious than money. So they're, you know, then they see these gurus online talking about how you go buy property, no money down, right? And they talk about subject to financing. Stop. It's not going to change your life. And I'm going to get into the reasons why. So first lesson number one is this. Don't listen to the gurus, because they teach everything from the eyes of the buyer. Look how easy it is. It's so simple. All you're going to do is take over somebody's payments, right? And I got a story about one of my students. I'm going to bring it up in this video, okay? Who practiced it for 2 weeks, swore it was a done deal, okay? Right? We'll get into that story. True story, told right in front of all the students from one of my students, okay? So you're not going to be able to go out there, right, and just take somebody's pay. Oh, I'm sorry. Let's get back to it. The eyes of the buyer, right? Look how easy it is. All you got to do is take over their payments. You sign an agreement of sale, right? You do this, you do that, you do this. And I'm going to show you exactly what you should do. I have it written down for you, okay? And that's it. It's so simple. Anybody can do it. Yeah, that's great. It is simple from the eyes of the buyer. But the buyer doesn't say yes or say no. You got to convince the seller that this is good for them. And what do you think a seller is going to do? Let me ask you this question. Are you going to hand the deed over? The deed. Here's the deed to my property. Now, this isn't really a deed. It's just some notes. Here's the deed to my property. Here's the keys to my property. Thank you for taking over my payments. Meanwhile, the loan stays in the seller's name. You got to worry about the bank, and that's why these guys twist like pretzels to get around the due on sale clause. Now, what the hell is that? That was a due on sale clause. Okay. In every note that you sign, this seller signs, and I'm going to show it to you, and you're going to see the language that's in the note itself, okay? So you got to remember, folks, I come from the lending side. I owned a mortgage company for almost 3 decades. I've been doing this for a long time. Okay? So I'm going to show you the real language that's in these contracts. Now, you're not breaking the law if you do subject to financing. You're not breaking any law, you're breaking a contract. The seller's breaking the contracts. Okay? And if you break the contract, the lender has the right to call the note due. What's the note? The note is the IOU, the money that you borrowed. I promise to pay you back $100,000 over 30 years at 7%. But it also says in there, hey, if you sign over your deed to somebody and you don't pay us off, we want our money. Why? Because let me tell you this. The gurus are all going to tell you, and only a slight portion of this is true. They're going to say, hey, the banks only care about getting paid. Now, that statement, I absolutely agree, is 100% true. They care about getting paid. Yes, they do. But let's go over this. When somebody wanted to borrow money, and they came to a guy like me, said, hey, I want to refinance, or I want to purchase, I want to buy a second home, I want to buy investment, whatever it is. Either you want to buy or you want to refi. Whether it's owner-occupied, non-owner-occupied, or a second home, okay? Whatever it is. I say, okay, fine. Here's what we do. We take an application. It's usually, 4 or 5 pages long. All of their personal information is in there for each borrower, okay? And then we collect certain documents. What documents do we collect? We collect 3 months of bank statements every page, okay? 1 to 5, we get all 5, even if it's blank, okay? We get 3 months of bank statements. We get 2 years of W-2s or tax returns. We get 1 month of pay stubs, okay? That's where we start. Then we pull their credit, not once but twice, once at the time of application and once the day before closing. We also verify their employment, not once but twice, once at the time of application and once the day of closing. And for those that think that you can have Uncle Johnny give you fake W-2s and pay stubs and say, hey, Uncle Johnny, when they call the barber shop, let them know I work here, okay? No problem, Jimmy. Fine. Got you covered, brother. They make you sign what is called a 4506 or an 8821. Now, what are those forms? Well, those forms that you have to sign at the time of application gives the lender the right to go right to the IRS and pull your transcripts. So they know exactly what you're doing. So if you didn't actually file those tax returns and W-2s, pay stubs, you committed bank fraud, which is a felony. Okay? So you're not going to get away with that anymore. Or if you wanted to try, you're not getting away with that. So you've got to do that. So you're jumping through hoops to get a loan. So what in the world makes you think that if the lender finds out that you did this and it breaks their contract, and they have no idea who you are, they didn't lend you the money, right, that they don't care? Because let me tell you one of the videos that's coming out very soon. I'm calling the top 10 mortgage servicers in the country, the ones that actually take the payments. Yes, hi, my name is Vinny. I was wondering if I could talk to the manager there. Yes, hey, this is John, the manager. Hey, John, how are you? Listen, I'm a real estate investor. I've come across a few clients that have loans with you, and I was wondering if I can get written approval to be able to do subject to financing where I can take their payments over. He's going to say, yeah, okay. Tell me who they are. No, I don't have any names for you just yet. I've just come across some of the clients that I was thinking about trying to, do this type of transaction. Are you going to allow it? Can I get written permission, please? And he's going to tell you, you're out of your mind, right? Now, there is a thing called an assumable loan, right? Now, you can't do it with conforming loans, but you can do it with FHA and VA, right? That's a different type of loan. Now, what does that mean? Now, an assumable loan, let me explain the difference. Actually, let me do it on the board here, okay? Let me explain what an assumable and what assumable versus subject to is. Let me do that for you real quick, okay? So let's do this. So there's 2 types of things out there that you might hear. One, let's do this. Assumable, come on, how about getting this to pen? Assumable versus subject to financing, okay? Because they're very similar. Now, on subject to financing, there are no banks. Over here, you're going to the bank. Over here, you're taking over the payment. Right? but the loan stays with the seller. Okay? Over here, the seller is removed. Now, the way they're removed is called a novation, the act of a novation. Now, some of you might have heard of a novation from these goofy wholesalers that are trying to sell you a new program, right? But what a novation is an act of changing a contract, okay? So taking a mortgage loan from John Doe to Vinny, that's an act of a novation, right? If I had an apartment and I signed a 1-year lease and 3 months into it, I can't stay there. Hey, but I found somebody else who will take over the lease. Okay, well, we'll just take that lease. It's 9 months left. We'll put it in their name. That's an act of a novation, okay? So now, on an assumable loan, the seller is gone. Gone. All the paperwork is in my name now. Now, with this here, I have to qualify for this. I have to pay some fees. Over here, there's no qualifying. Why? Because there's no bank. No qualifying. There's I don't want to say no fees. There is fees, but there's no fees to the bank. But there is money that you do have to pay. Okay? So now, an assumable loan is a loan that you can go to the bank. By the way, it can only be owner-occupied. You can't do it as an investment loan. You go to the bank, you say, hey, I want to take over somebody's payments. Right now, why would you assume a loan? Well, if you want to live in that house, again, instead of getting a 30-year fixed rate from the bank, a brand new 30-year fixed rate at, say, 7%. I know the rates have ticked down. Maybe they're 6, maybe they're 5. I don't know. I don't keep track of the rates. But let's say the rates are at 7% for argument's sake. So instead of getting a 30-year fixed rate at 7%, I can assume their loan that only has 23 years left at 4%. Well, I'd rather do that, right? Now, I might have to put money down, but that's okay. It's okay, right? So whatever the situation is, I'm assuming their loan. Now, what will happen is the bank takes the seller off and puts me on, and now I just assume that loan, and I took over the payment. But the seller's completely out of it. They're no longer in that transaction. Subject to financing is different. There's no banks, okay? We're just taking the payments over. We're signing the deed over, okay? But the loan stays in the seller's name. Now, again, let me ask you a question, a very simple question. Are you going to hand the deed and your keys over to somebody that you have no idea who they are and say, yeah, thank you, and the loan stays in your own name? I can tell you, I talked to 1,000 different sellers, and not one of them said, yeah, I'd do that. And then they'd say the next thing, who the hell would do that? Well, obviously, somebody who's completely motivated and desperate as all hell, yes, of course, right? But are they going to give away their equity? And what do I mean by that? I'm going to get to that, okay? So let's talk about subject to, because that's what we're talking about. Let's get into it right now. What is it? How does it work? What are the pros and cons? I wrote out a little thing for us, okay? I've typed out, let me rephrase that. I typed out a little thing for us, and I'll pull it up on the screen here. There we go. Okay. Subject to financing. Here we are right here. This is the screen. Okay. Now, what I wrote here is I said, keep it simple. Keep it simple. This is simple. You're just taking over the seller's mortgage payments. Let's go over the pros. Let's go over the cons. Let's see some of the stuff you should do. So the pros, again, there's no banks involved. There's no credit needed. There's no job needed. There's no qualifying, right? Because there's no banks. You can get a better rate than current rates. Again, I just explained it. So instead of going to the bank and getting a new 30-year fixed rate at 7%, I'm taking that payment over that's got 20 years left at 3%, okay? Which then brings me to this. I got a shorter term, right? The term is how long, the length, okay? And you have no risk. Why? Because nothing's in your name except for the deed. But the loan is not in your name, so there's no risk to you. Now, what are the cons? Okay, this is not, I don't want to say a no money down transaction, because you could put no money down, but you do need money. So let me say it that way. I don't want to say it like that. Let me say this. You're going to need some money to do this type of transaction, okay? You have an issue with the due on sale clause. The loan is going to stay in the seller name, and the seller, you also have to let them know the seller has to qualify with this loan in their name. Okay? Now, you're going to hear the guru say, no, 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 you're wrong, Vinny. No, 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 I am right. And I'm going to prove I'm right because everything that I teach, I back up with facts. And then I bring the facts with me and then I show them to you. Okay? Now, again, so far, very simple. We're just taking over somebody's payments. Okay? Here is, before you even thinking about doing a deal, okay, some of the things that you should do at a bare bones minimum, right, if you're trying to do this, okay? Number one, you should always pull the title, okay? Now, what's the title? The title is going to show you everything about the house, who owns it, what liens are against it. It's going to have a copy of the deed in there, right? It's going to give you all the information. It's going to give you a chain of title, which means who's owned it, when, right? And then who it got transferred to, any loans that are against it. Now, why do you need that? Okay, because let me explain. When you go and sign an agreement of sale to do this subject to financing, so one, you need to know how to write an agreement, okay? Do not rely on others to do your work. If you do not know how to read or write an agreement of sale or read an agreement of sale, you are not a real estate investor and you're not educated, okay? You do not rely on some realtor or some third party to write your contracts. You need to know how to do it. You should know how to do it. And my students learn how to do it, okay? That's a basic 101, how to write a contract and what contingency should be in there and everything else, okay? So before you write the contract, you're going to pull the title, okay? Who's going to show you what liens are against that property and who the owners are, okay? So number one, that no one's committing fraud against you. Don't say it doesn't happen, because one of my students, it was happening to her. And we got the title, and I'm like, hey, Luana, this does not make sense at all. The guy you're trying to, flip this home with isn't on the title. He's nowhere to be found. And then we got all these cockamamie oh my God. I'm like, this is fraud. Stay away. And it wound up being fraud, okay? So you want to make sure that who you're negotiating with are the owners. Now, but anybody who's on that deed, whoever is on the deed, must be on the agreement of sale, okay? So that's why you also need to pull title. Now, in my humble opinion, if you buy a house without doing a home inspection, it's not very smart. Why? Because you want to know what you're buying. You want to know what you're buying and what you're getting into. I don't care if you think you're going to go do a lease purchase to somebody and get money up front and sell it for more than what it's worth, and you're not going to have to put your hands on it. Stop. You will at some point. So know what you're buying and know what you're getting into. Okay? So do a home inspection at a minimum. Any house that I've ever purchased, home inspection. And I learned something this year and listen, I always thought I knew a lot, but I learned something this year that I'll tell you. We were doing a deal where realtors couldn't sell their house. Brand new house on the main line, didn't sell. And they were trying everything under the sun, including a lease purchase, everything, right? They would never do this. So I came to them and I got it done in less than 30 days over the Christmas holidays. And here's what happened. This is a brand new house. Guy says, listen, we're going to do a home inspection. I'm like, why are you doing a home inspection? You got a home warranty? He's like, listen, Vinny. He's like, you don't know, like, look, I build homes. I'm like, I build homes too. It's like, why? He said, because you don't know if the person had a bad day. You don't know if the township guy who's inspected it had a bad day. You don't know. And here's what you should do as a builder. As a builder, you should do your own home inspection so that you can tell them, go through with a fine-tooth comb, so that when a buyer goes through it, you know there's not a damn thing wrong with it. I'm like, you know what? That's a great idea. That's a great idea. From now on, every time I build a house, absolutely, before I put it on the market, I'm going to get a great home inspection, right? And I'll tell you about how I do home inspections, right? They're there all day, okay? I don't have guys running in to go do 5 of them. Do a home inspection so I know that everything was done the way it should have been, even though I'm usually there. But you're right. You never know. Maybe I wasn't there one day. Maybe something happened. Who knows? But at least we find everything before a buyer finds it, even though there's home inspection and everything else. So I thought that was good. So do a home inspection, okay? Do a home inspection. Okay, you should be very good at knowing the fair market values and fair market rent. So anytime you see FMR or FMV, this is fair market value. FMR is fair market rents. Now, why do you need to know that? Well, listen, because if you're buying a house and if something happens, okay, and you're just buying it for cash flow, but they're in over their head and you're in a negative equity position, and the note gets called, how are you getting out of it? And don't tell me you're just going to hand the deed back to the seller. That's a jerk off move. Stop. If you're going to do stuff like that, don't be a real estate investor. Okay? So, and then the next thing is you want to know the fair market rents because you want to be able to make cash flow on these properties. So you should know all this stuff. If you're an investor, you need to know your market. Trust me and my wife used to drive around every weekend and go to every single house in every market that was for sale. Go in them, right? Analyze them, find out what sold, what didn't sell. So we can tell, hey, this 4-bedroom, 3-bath in this house goes for this, it rents for this, right? Know your market. Be a real estate investor. Don't be a schmo. Okay. Also, review the seller's mortgage information. Why? Because A, you don't want to make sure that it's like 3 months behind, 4 months behind, 5 months behind, and they're facing a bankruptcy that they didn't tell you about. Review it. Also, make sure you want to see if the escrows is included in it or you got to pay your taxes and insurance, which then you got to review the taxes and insurance as well. Just so you need to know how much all this is what the outlay is, okay? And where and who you got to pay it with. So that's bare bones before you even write up the agreement. This is stuff you need to review, okay? So then you can run your numbers. You know who the owner is, who you got to negotiate with. Now, I'm not saying you should do a home inspection. Do it if you sign the agreement of sale and you want to move forward with it. Then you do the home inspection, right? But make sure in your agreement you got contingencies to get out of it, okay? Know what your fair market values are so you know you got some equity in it, okay? Because if you need to get out of it quickly. And also the fair market rents that you know you're going to make some cash flow on it. That's your bare bone minimum stuff, okay? Now, if you still decide that you want to move forward with it, what happens during the transaction? Okay. Well, listen, obviously you got to sign an agreement of sale with all the parties that are involved. It's number one. It's why you need the title, okay? So let's get into the transaction. Let me just move this paperwork up a little bit, and let's go into here, okay? So you're going to need, I would get title insurance. Why? Because you could do this one of two ways. You could get what we call a quit claim deed, right? Which is a cheap, dirty deed. That type of deed is usually done with divorcees. Okay, let's just say my wife left me for a younger, athletic, handsome man, right? I'm fat, old, bald. It's, I'm worthless, right? And she's a hot mama, so she found somebody younger, hotter, right, and decided to go. But she goes, you know what? As a consolation prize, you fat old bastard, I'm going to give you the house. So she signs the deed over to me. How? Through a quit claim deed. Now I know, well, actually I'm not even on the deed, it's her house. But let's just say we were on it together, right? I know what liens are against it. So I don't care that she signs it over. I don't need insurance. I don't need a warranty. If you're buying it from somebody you don't know, you want to get title insurance. Why? Because if something pops up, you're insured against it, okay? So you should get title insurance, and you should close with a title company, okay? You're also going to need to change the homeowner's insurance into a renter's policy, but you have to keep it in the seller's name, okay? Why? Because the seller has a loan that you're taking over, and the insurance needs to be in the first insuree. You'll be an additional, what they call additional insuree, okay? So once you change the policy to a renter's policy, you could put your name, your LLC, or your trust, however you're doing the transaction, as the additional insuree, okay? It's very simple. It's not hard. I'll show you how to do it, okay? Now, by the way, for those out there that want to try and do this, right, and don't want to plunk thousands of dollars down, if you want to do this, or if you have somebody that's interested in doing it, I'll help you. No charge, free of charge, okay? Just give me a call. I'll help you out. I'll help you do the contract. I'll help you do whatever you need, all right? So make sure you get the agreement of sale signed by all of her on the deed. Make sure you got all your addendums in there, right? Make sure you got proper contingencies in there just if you want to get out, because if you find something on the home inspection, you want to make sure you got a contingency to get out of this, right? Now, this is also very important. You need to have what I call an authorization to release info. And I have this, right? This is from my mortgage company. This is stuff I have from the mortgage company left over. An authorization to release information, because the bank, you're not on the note or the mortgage or the bank's paperwork. So they're not going to talk to you. But if you get an authorization to release information, right, they will talk to you. But you also need what I call, the way that I say it, is a limited power of attorney specific to the transaction. But you need it from all the parties on the deed. So everybody's on the deed. You need to get a limited power of attorney specific to the transaction for this. They're not just going to sign a generic limited power of attorney. So again, it's called specific to, right, limited power of attorney specific to the transaction. Okay? So it's just specific to this house. Now, you can talk to the tax people, you can talk to the mortgage people, you can talk to anybody that needs to be talked to. Okay? So you need to get those papers at a minimum. You need to get those, okay, during the transaction. Now, at the closing, let me see here. What do I got here? Yes, I would do a warranty deed over a quick claim deed. Again, the quick claim deed is just quick, it's dirty, there's no insurance. Whatever's on the house is what you get. Warranty deed, now, you know, they're not ensuring that you're getting a free and clear property or anything like that. But anything that pops up after that is, or I'm sorry, before that. So if something pops up, you got insurance, they'll take care of it, okay? And you're closing with a title company. That's what you should be doing. You make sure that the deed's signed over, right? You're going to transfer the deed. You know, you got to sign the HUD-1, all now called the closing disclosure, right? I'm old school, so I just call it a HUD-1. I'm so used to it. I'm sorry. I apologize to all your readers out there that want to call it a HUD-1 or alt or whatever you want to call it. I don't care, right? Now, this is funny because the next video is going to be all about this CYA letter. Now, I wrote this down there because this is the stuff that the gurus teach, not me, because I'm going to talk about it in a minute, okay? We'll get back to this, the CYA. What does CYA letter mean? It means cover your ass. That's what it means. Sorry for the language, right? I got a potty mouth, right? That's mild, with usually comes out of my mouth, okay? But that's what that means. And why did they get that signed? Because when this goes south, and more than likely it'll go south, right? And you're in front of a judge, Your Honor, we signed this, right? Okay, we don't care. All right, you need an escrow letter. An escrow letter is taxes and insurance, right? Because you got to know who's paying it, where it's getting paid, all that stuff, when it's due. Well, we know when it's due, but you need to know where it's going, all that. Is it escrowed with that? Okay. You got to get the mortgage statement. Okay. Now, again, this is a guru thing. They say this to get this. Why? To get around the due on sale clause, right? I'm going to get on to the due on sale in a minute. I'm going to get on to two things. Due on sale and the CYA letter in a second, right? The property manager, letter from the sellers naming you the property manager that you will now be making mortgage payments, right? Or you're going to put it into a land trust. Okay. Now, why do they do that? Okay. They do all that because, right, they know that if the bank finds out, they can call the note due. Now, I'm going to get into that. I'm going to pull the paperwork out in a minute, okay, that shows you that. So you see how easy the transaction is. It's not a lot of paperwork. It's not very hard, okay? But it does cost a little bit of money out of your pocket. Now, what do I mean by a little bit of money? Okay, here's a few things that you should pay for to do this transaction. Now, of course, right now, we're trying to do it no money down, meaning we're not giving any money to the seller, meaning this. The house is for sale for $100,000. They owe $95,000. They're expecting $5,000. They'll do subject to, but they want their $5,000. Okay, you're trying to do it without giving them the $5,000. Okay, so that $5,000 is money down. Okay, you want to do it, no money down. So you just want it for $95,000. Now again, these are silly numbers. I get it, but I'm giving you an example. But where does money come out of your pocket? Okay, let me explain. Number one, first place that money's going to come out of your pocket is doing a title search. Now, you can do a title search for free if you want to. You go down to the courthouse. First place you go to is to the pathonetary. It's usually on the first floor. You go there, and then you go up to the recorder of deeds. And you'll be able to get the information that you need for free. And they'll help you. And they're very nice, and they're very kind, and they're very accommodating. And if you need anything printed out, it costs like 50 cents or $1, right? A page. It used to be 50 cents when I used to go there, but I didn't go there a whole lot. I had a title company that did it for me, right? And did it for free. But I used to give them a lot of business. They're not going to give it to you for free. So it's going to cost you money to get a title search. How much? I don't know, maybe $100. It used to be $50 back in the day, but that was back in the day. Now it's probably $100, at least $100, okay? But they'll get you a title search. Now that's not title insurance, That's just giving you the basic information that you need. Who you're negotiating with, who needs to be on the agreement of sale, right? Who needs to be on the transfer of the deed, right? And what loans are there. Okay, once you got what loans are there, now you can get the mortgage statement and see how much their payment is. And does it or does it not include the taxes and insurance? Tax and insurance are what we call the escrow. Okay, so if you hear the word escrow, you know that that means the taxes and insurance, because your payment is broken up into this: principal, interest, PI, and then TI, taxes and insurance. And it could also mean PMI, but we'll get it. Don't worry about that right now. All right, so that's why you have to look at that. So that's the first fee. Now, that's not a lot of money. You can pay with a credit card, right? That's not a lot of money, okay? So the next thing that you would have to pay is what? Is the home inspection. And again, that's not a whole lot of money, but that's the cheapest insurance you can get about buying a house, because you know what you're getting into, right? And don't be the guy that you do subject to financing, you get the deed taken, and next thing you know, the foundation is cracking, or the septic tank blew up, and it's going to cost you 30 grand. You're like, I got $30,000. Well, you're the owner of the house now, right? And you're like, oh, I'm not doing this deal. And you give the deed back to the seller. Oh, I don't want to do this deal anymore. Here you goes your deed. Don't do that. Don't be that guy. If you did a home inspection up front, you know that's the end of its life, or the roof starts leaking, right? But they told you that. Or what happened to one of my students when I told him to use a home inspector that I recommended? He didn't. He went with the realtors. And what happened? They didn't even look at the oil tank. And now it's cold out, and the guy says, I can't put oil in the tank. Why? Because the tank is so rotted out, it's only going to fall on the floor. Okay? Is that what you want to buy? So the cheapest thing you could do is get a home inspection so that you know what's wrong with the house. You're going to be the owner. And I don't want to hear, oh, I'm going to do at least purchase it. I'm going to make them responsible for everything. Yeah, okay, what up? Shut up. Okay, you don't know what the hell you're talking about, because that's one of the worst ideas I ever heard of. And I'll get into that at another point. Okay? Trust me, I'll get into that. So that's the next thing you got to pay. What's the next thing you're going to have to pay? Okay, you're going to have to pay transfer tax. Okay? Well, before we pay the transfer tax, we got to pay title insurance. What's title insurance? That's to make sure, right, that everything goes smooth with the settlement. You're paying the title company and you're getting it insured. So that if anything pops up after you sign this, you're not responsible for it. The title company is responsible now, right? You're insured. You got a warranty through a warranty deed, okay? You're not doing a quick claim deed. That's kind of worthless, all right? So now you got to pay title insurance. And that's going to cost you a few dollars. It all depends on the sales price, okay? Then the next thing you got to do is pay transfer tax. Now, what is transfer tax? Well, that goes to the government. Anytime you transfer property from one person to the other, there's transfer tax. Here in Pennsylvania, where I live in the suburbs of Philadelphia, and where I live, it's 2%. Now, it's usually customary that the seller pays one and the buyer pays one, okay? It's not mandatory. That is a totally negotiable item. So you can say, hey, I want the seller to pay all of it, like if you're doing a regular deal. Oh, no, I want the buyer to pay it all, right? It's a totally negotiable item. Now, if you're trying to do a no money down deal, doing subject to financing, do you honestly think they're going to pay transfer tax? No, so now you got to pay, and it's 2%. Oh, well, I'm just going to do $1 deed transfer. Okay, good luck with that. You're not going to pay 2% on $1. They're going to take the assessed value. There's always an assessed value at the township, right, in the county. They know, okay? That's how they base the taxes off of it, okay? They base it off the assessed value. So you're going to pay the 2% off the assessed value if you do a $1 deed transfer, okay? And in my opinion, you should just do it the right way, pay your transfer tax and move on, all right? So there's money that you should have. And then I saw a video with this Pace Morley guy. He's one of the biggest stone cold frauds I've ever seen, that guy. He's the worst. Oh my God, is he the worst. I'll get into that guy in another video, right? But I saw him say, I bought this property right here without one penny. I didn't use one dime, not a nickel, right? And I'm thinking to myself, how do you fucking buy this property without a nickel? Who did the home inspection? How did you get the title insurance? How did you transfer the deed? Someone had to pay that. Now, I'm not saying my video had anything to do with this, but I laid it out right after that video came out. I put a video out there. Now, I know I am a nobody on social media. I know that. I know that I am a pimple on an elephant's ass. I get that, okay? However, I'm smarter than all of them out there when it comes to this real estate stuff because I've been doing it for 40 years. I just don't make things up and say I'm a YouTube guru, okay? And I'm not saying it was my video, but I am telling you, the week after that, he didn't say that, and he doesn't say that anymore. So go back to his original videos, because his original videos are, I buy these properties, no money down, not a penny. I use no money whatsoever. He doesn't say that anymore. What's he say now? He says, I don't use any of my own money. Yeah, he uses his students' money. He says he has a private lender. Okay, well, he might have a private lender, but let me tell you this. What's a private lender? A private lender is like a person, individual, company that lends money. Okay, they get a nice return on their money for risky loans. But let me tell you this: there's not a private lender in the world that's going to lend you a person like or me, like a nobody. They're never going to lend money to us on a deal, especially going into the second lien position behind a subject to financing deal. Meaning this. We just took over, we did a deal and we just took over, I'm not saying this is a real deal, I'm just giving you an example. We just take over, we got a deal, the lady owed $100,000, the house was only worth $110,000, but we had a lot of cash flow because she had a low interest rate and she's only got like 15 years or 20 years left on a 30-year loan. So we took it subject to, even though, there's really no equity, okay? So we take it subject to financing. Right, but now we want to borrow money. We got to pay her off. Right, let's say $20,000. Well, there's no private lender in the world that is ever going to lend us money and go behind a second lien. Now, the first lien is the bank that has the money that lent it to the original seller, so they're in the first lien position, and then anybody else after that will be called in the second lien position. Okay, and I can show you how that's done. Let me kind of show you what I mean by that, right? Because that did get a little confusing. So let me do this for you. All right, let me do this. Let me erase this board and let me show you what I mean. Okay, whenever somebody borrows money from a bank, so let's do this. So this, let me just change this color here. So here's the bank, right? This is the bank. Okay, and this is the seller. Okay, this is the buyer. The buyer wants to buy this house, okay? And it's $200,000 is the sales price, okay? So the buyer is, he's putting $50,000 down, okay? So he puts $50,000. So he goes to the bank for what? For the other $150,000, okay? So now the seller, he gets $200,000, right? Done. He gets the $200,000, okay? Now, the seller gives us the deed if we live in a judicial state. If we don't live in a judicial state, it goes into a trust. But I live in a judicial state, so I get the deed. So there we go. So now I have the deed. Now, I sign a note, right, from the bank. The bank makes me sign a note, which is the IOU, okay? Signs a mortgage, which is the security for the bank. Okay, that's their security blanket, and a HUD-1. That's the money. Okay? So the bank makes me sign that. And then what the bank does is they put a lien of $150,000 on this house. So ABC Bank is now, do you see that? In the first lien position. Okay? And exactly like I said earlier, what it says is what it means. So the bank has a lien. The lien is what? The note. And they're in the first lien position. So the lien is this money, okay? And they're in first position. So that means anytime you sell your property, okay, that bank gets paid first because they're in the first lien position. Now, when we talked about a private lender, right? Because, the way that Pace Morley likes to do its deals is this. The house is for sale for $300,000, right? And the seller needs $50,000 because that's the equity that they have. What is equity? Equity is the difference between what it's worth and what you owe. So I owe $150,000, it's worth $200,000. I have $50,000 in equity, and that's what I want. I'm selling the property. Okay, it's $200,000. I owe $150,000. I want $50,000. I'll do subject to. Okay, so he comes along. He gives the buyer $50,000. He pays the student $10,000 as a wholesale fee, right? And he takes that first lien subject to financing, okay? So now he's got a first lien, and that's the seller's loan. That they're in the first lien position. Now, his private lender is in the second lien position. And what I'm telling you, take this to the bank, okay? Because I borrowed hard money before. It doesn't feel good, trust me, right? So it's almost the same as private money. Hard money is a little bit worse. I don't know any private lender that A, will go into the second lien position, especially anywhere near 100% loan to value or even 80% loan to value. Private money lenders want to be 70, 65%, 65, 70% loan to value. Why? Because if they got to get rid of it, they can. I don't know any private lender that will go behind a subject to financing deal. They just don't do it. Now, so we talked about this, and I said that if the bank finds out that we do this, they're going to call the note due. Now, the note, again, what I said was the IOU, right? So let me pull up. I'm going to pull up now, if you give me 1 second, okay? What I'm going to pull up for you right now is this, okay? This here is from the bank. This is an actual note from one of my borrowers, okay? And this talks about the due on sale clause. And we're going to go over it together, okay? So let me pull it up on the screen. Let me make sure. I want to make sure we can see it. Let me move my walking stick. I want to make sure we can see it, right? So that we can talk about it together, okay? Now, I know that my camera is not the best. I bought a used one, but it's supposed to be a really good document camera. So it'll be a little bit better in the future, and I apologize for the way it looks right now. All right, so right now, okay, let's get to it. All right, here we go. Okay, now, again, this is in every note, okay? Or any note that's secured by a bank. Private notes, no, okay? Let's get into it. Here we go, all right? So, you're going to see here, oh, hold on. Wait a second here. Oh, here it is. All right, let me just get my pen ready. Okay, so so you'll see here, right? Uniform secured note. The note, again, is the IOU, all right? And then we're going to start right here is where we're starting, all right? This is the section that we need, all right? Now, I don't know. I can't make it any bigger. Let me see if I can move it down a little bit. Let me delete that. Sorry. Okay. Let's see if I can make it. All right. I literally just bought a new document camera, and it didn't arrive yet. Well, I bought a used document camera because the really good ones are very, very expensive. So I bought a used one, okay? So, but it's not here right now. All right, so let's read what this note says. Now, this is when a seller goes to the bank and signs their paperwork. And this is what the bank says, okay? Here we go, right here. All right. Now, if at all or any part of the property or interest in the property is sold or transferred, or if the borrower is not a natural person and a beneficial interest in a borrower is sold or transferred. All right? So really forget that. So if all or any part of the property or any interest in the property is sold or transferred without the lender's prior written consent, the lender may require immediate payment in full of all sums secured by this security instrument. Okay? It's secured through the mortgage. This instrument is the note. Okay? Now, however, this option shall not be exercised by the lender if such exercise is prohibited by law, applicable law. Now, let me tell you what that means. Okay. So far, what it's saying is this. If you sell your property, we have the right to call the note due unless there's a law. Now, what do they mean by that? Okay. If you don't sell your property or transfer your property through subject-to financing, let's just say, something happens. Rates go up, right? You missed a payment. They cannot just call the note due because you didn't break the contract. They have no right to call the note due at any time. So they're breaking the law. The only time they can call the note due legally is if you do something like this, like transfer your deed to somebody that they don't know without prior written consent. They want prior written consent. And I'm sure they're going to want the buyer to jump through hoops. Okay? They're going to want to qualify them. Why wouldn't they? That's what they're going to want to do. And again, if you don't believe me, I got videos coming out where I call and I videotape it and it's on speakerphone where we call and talk to 10 of the top mortgage servicers in the country. Okay? So that video is coming soon. Stay tuned. Okay. So they just can't call the note due for any reason. They can't do that, right? There has to be a reason to call the note due. So let's get into paragraph 2 right here. If the lender exercises this option, right, which means they're calling the note due, okay, the lender shall give the borrower notice of acceleration. That's why it's called an acceleration clause. It's called an acceleration clause. Okay? Also known as a due on sale. Okay? Okay? So the lender shall give the borrower notice of acceleration. We're accelerating your note now. The notice shall provide a period of not less than 30 days. So now you have 30 days. But I'm going to tell you a little secret in a minute. From the date of this notice is given in accordance with section 15, within which a borrower must pay all sums secured by this instrument. So whatever the amount of money you borrowed, well, what you still owe is what you owe, okay? That's what they're calling due, okay? If the borrower fails to pay these sums prior to the expiration of this period, that's the 30 days. The lender may invoke any remedies permitted by the security instrument without further notice or demand on the borrower. Now, what does that mean? Okay, let me tell you what it means. When you miss 3 payments and they start the foreclosure process in a judicial state, okay, they have to give you notice. They have to go down to the courthouse. They got to get a judgment against you. That's why foreclosing can take a year or longer, okay? So now, they have to go down. They have to get a judgment, okay? So they have to sue you. Then they got to get a judgment, and then they have to sell the property through a sheriff's sale to get pay their money, okay? But they called the note due. That's what they did because you did this, okay? Now, they're giving you 30 days. Say you got 30 days to pay in full. If not, we're foreclosing on you, okay? That's our remedy, foreclosure. And what they're saying is we don't have to go through the normal foreclosure notification bullshit because you broke the contract. The seller broke the contract, and we're accelerating it now, right? We're accelerating because you, the seller, broke the contract, okay? But here's the deal. They give you 30 days. Now, let's just say that you bought a house subject to, and they called the note due. What's going to happen? Well, you got a couple of options. One, you can sell the property right away. That's why I said you better have equity in it. That's why you should know the fair market value so that you can flip it and get out of it immediately. 2, you can refinance it, but again, you need equity in it, right? Because if you're going to do a non-owner occupied rate and term, that's a 75 LTV, okay? Now, you can do a DSCR loan, which is a debt service covered ratio loan, which is a higher interest rate, right? As if you don't have income. You can do a DSCR, you can go to 85 LTVs, which means you still need to have equity in the property, okay? So if you can't refinance it and you can't sell it, what are you going to do? Where are you going to go? Now, I hear a lot of these, when I bring this up to the students, they're like, oh, well, the guru said just give it back to the seller. Really? That's your solution? Give it back to the seller? I was going to say a bad, nasty word. What kind of person are you going to be to really do that? You're not an investor then. Don't become an investor. If you can't pay it off, you don't have the means to pay it off, you don't have a job to pay it off, you don't have the income to pay it off, you can't do a DSCR loan because you ain't got credit, whatever it is, if you can't do it, don't do this at all. Don't do it. Because when they find out, they're going to call the note due. Okay? Because they're not just going to say, oh, okay, just keep making the payments because we only care about getting paid. No, they don't. Because if they only cared about that, they would not make you jump through hoops to get a loan in the first place. They wouldn't make you do all that. Why would they make me sign a 4-page application, 3 months bank statement, 2 years W-2s, right? Pay stubs and sign a 4506 and they call my verifier and pull my credit twice. Not once, but twice. Why are they doing that if they only want to get paid, right? They should just see, oh, look at my credit report. I got a good credit. You know you're going to get paid. The hell do you care about anything else? Because they do care. They care who they're lending their money to. Okay? So, that's what the bank says. Now, are you going to be able to sleep at night knowing that that's over your head? And the other gurus are going to say, well, I'll become the property manager. That's what we said earlier, right? Tell them that you're the property manager and you're the one going to be making payments now, right? No. If you want to do this stuff, do it the right way, which is you call the lender and say, hey, Mr. Lender, I have a borrower here. Their name is Mr. and Mrs. Smith. We're going to enter into a contract to do subject to financing. I'm going to be the guy taking over their payments. I just need to get it in writing that it's okay that we do this. Okay? So can I get a letter stating that? And don't think for 1 second that you're just going to get a letter from a secretary, right? That they're going to write it up and give it to you, and you think you're going to get away with that. Okay. Yeah, you're going to get away with that. First off, she or they are never even allowed to write that type of letter up. And if they did, they'd be fired in 2 seconds flat. Okay? You're going to have to get a manager on the phone, and the manager works for the bank. And if you think for 1 second that's going to happen, you're out of your mind. Okay? And you'll see when we make the phone calls. Okay? So I don't want to hear the guru says they only care about getting paid. Yeah, okay. Good luck with you and the guru. Okay? So there you have it. There's what a due on sale actually says in there. Okay? Are you breaking a law? No. You're breaking a contract. Okay? So there's no threat of going to prison or anything like that. You're just breaking a contract and they're going to foreclose on you. And if you can't sleep on that pillow, don't do this. By the way, there's way better options of doing this anyway. Okay, so now that's one of the things that's facing you and the seller. Okay? And I don't know many sellers that are willing to face that. Now, the other thing, right, that I talked about is that what's going to happen, and excuse me while I get it, right? And by the way, just so you know, when you come to, we have the False Profits podcast, but the name of the company is the Real Estate Underground by Vinny. And then we have the Golden Triangle Academy. That's our school. This is just some of the paperwork that you learn for subject to financing. This is my little teaching folder and it's not even all the paperwork. Okay. So now, once we do this, the next thing that they say about the seller is this. They say, well, what I mean by that is, remember I said that the seller's going to ask you, well, what happens in 2 years if I want to go buy a new house? Well, all the gurus say the same thing. Well, what you need to do, because let me tell you what they're worried about. And I'm going to show you this one let me show you this one here, okay, because this is important, okay? I didn't teach you this. When you want to get a loan, okay, when you want to get a loan, it takes 4 things to get a loan from a bank, okay? 3 of them are very simple and easy to explain, okay? You don't even have to write it down. Number 1 is your credit score. 580 to go FHA, 620 to go Fannie or Freddie. Okay, if you don't know what that means, don't worry about it. Just know you need a 580 or a 620 to get a loan. Okay, that's it. Okay, 580 or 620. Okay, credit score, minimum credit score. Number 2, you need 2 years on the job or in the same line of work. And if you went to school for that, like a welder or an iron worker or somebody who went to school for 2 years and now is in the field for a year, that counts as your 2 years as well. You're good to go. As long as you're same line of work, okay, you're fine. If you got 5 jobs, but they all been in the same kind of work, you're fine. 2 years in the same job. You're good to go, okay? The next one is your down payment or your equity. Down payment, if you're buying a house, okay, you need to show that you have the money for the down payment. Or the equity, if you're refinancing. Do you have enough equity? What is equity again? The amount of money that you owe to what it's worth, right? Do you have enough equity to borrow money, okay? The last is what people get confused out, and I have a form that I give to everybody. It's called a debt-to-income ratio, okay? And this is how you qualify. You have to qualify for the amount of money that you're borrowing, okay? Now, we're only going to talk about what we call the back-end ratio. What does that mean? Let me show you. Okay, so when you hear something along the lines of what we call a back-end ratio, okay? It's a ratio. It's a ratio of the amount of money. It's your amount of money of your payment versus the amount of money that you make. So how does it work? Okay. So the way it works is this way. They take your PITI. This is your payment. Okay. Your monthly payment. It's got your principal, interest, taxes, and insurance. Okay. You divide that by your gross monthly income. I'm sorry. I screwed that up. Oh my God, how pathetic is that? Let me redo this. It's your PITI plus I was doing the front end. All your monthly debt. Your monthly debt. Now, what debt? Okay. Not your cell phone, not your water bill, not your cable bill. The only monthly debt is the debt that you sign for, like credit cards, student loans, installment loans. Like if you bought something on installment, like furniture, buy now, pay later, that kind of thing, right? Auto loans, okay, boat loans, any type of loan that you've bought something on, that's your monthly debt, okay? Then you divide that by your gross monthly income. That number needs to be 40% or less, okay? So let's just say our PITI is $1,000 and our total monthly debt is $500 for a total of $1,500. And then we're making, say, $10,000, okay? And let's say $6,000. We're making $6,000, okay? So we take those numbers and we divide them, right? So you take, so that's, what is that? So that's, let me use a calculator. So you take your PITI, $1,500. Oops, can I even see it? 1,500, oop. Can't even see. Damn, I'm going blind. How terrible is this? Remember I told you about my wife leaving me for a younger guy? I mean, that's probably what's going to happen, okay? Because it's terrible. So $1,500 divided by 6,000, right? That's 25%, okay? So 25 is less than 40, I qualify, okay? Now, I have, for anybody that wants it or needs it, I have this form, okay? I have it somewhere, right? Very simple. Let me see if I can pull it out real quick. If you just bear with me 1 second, I might be able to show it to you real quick, okay? We're just getting ready to do a first-time homebuyer seminar, and I think I just saw this in my form, right? Yeah, here we go, right? Well, this is for a purchase, right? So this is basically all you need. Let me show you this, and then we can move on to the other thing. Let me just take a quick peek real fast, right? If I got it, okay. So let me just do this, and I'll show you this. And then if anybody wants it, right? I'm sure you can find it online, but if you want it from me, I'll give it to you, right? Okay, so here we go. So right here, you'll see this is the pre-qualification that we use for a purchase, right? So you see up here, right? You just write your name, right? Right? Your email address. That's for marketing stuff. Your phone number, the app. Okay, so your sales price, right? So $100,000, right? Down payment $10,000. Okay, loan amount $90,000. Okay, yearly income, $65,000, right? Yearly income $35,000. Okay, so total gross monthly income, right? So we got 100,000, right? So we got 100,000, right? Divided by 12, right? So we got 8333. Can you guys even, right? 8333. So monthly debt. Okay, we got a car loan of $330. We got a credit card of $33. Another credit card of $33. A student loan of $133. Right? I mean, some people might consider that I might be a little bit 33. Right? Yeah, whatever. Okay. So what do we got here? So let's do this real quick. All right. So let's just say that this $90,000 equals, we're just going to say that this $90,000, let's just say is like $800 payment. Okay. So we'll take 800. Now we're going to add this up. So 330 plus 33 plus 33 plus 133. Okay. So this total debt is $529. Okay. So let's move it down. Right. So then we got excellent credit. Right. And we go to the next page. Let me delete that. Right. Let me delete that. Sorry. So the next page just shows you real quick, right, of how you would do it. So now you just go in here, right, and then you take your monthly payment, right, your total PITI payment, right, which we said was $800, and then I forget what we said on the other one. We'll just say 333, right, and then we divide it by $10,000, okay, and then this will be our back end ratio. That's my wife right there. Okay, so that's how you figure out a PITI. That's how you figure out your gross monthly income. That's how you qualify for a loan. Okay, now The question that the seller is going to ask you, and we're going to pretty much wrap it up with this, and we'll go on the video 2 and 3. The seller is pretty much going to ask you this. Okay, well, I got to worry about the due on sale clause. Okay, but you said you're going to pay me off pretty quickly if that happens, right? Or maybe a year or two. So my question is, what happens if I want to go and buy another house in like 2 years, but this loan isn't paid off? All the gurus will tell you this. Well, as long as you show them that we're making the payments, it doesn't count against your debt. What debt? Remember that total monthly debt, right? Your monthly debt? Okay, well, you need to add that in. So the seller has to qualify with that debt added in. So now they have the first payment, this payment, plus all their debt divided by their gross monthly income. And most people don't qualify with 2 mortgage payments in their name. Now, the gurus all say, hey, as long as you show them that we're making the payments and we'll provide that for you, you won't qualify. Now, that is not true, okay? And I'm going to tell you why. Again, I come from the lending side. And what I'm going to show you right now, again, I don't just say things, I prove things. And I'm going to prove it to you again. I just showed you what the due on sale clause says. Now I'm going to show you what it says about the seller trying to qualify. Because now you have to tell the seller, Mr. Seller, unfortunately, it's going to count against you in your debt to income ratio. Okay? And he's going to be like, what? Well, I don't know if I'm going to be able to buy another house. That's right. You might not be able to buy another house until we pay this off. Okay? Now, most gurus are going to say the opposite. But what they are referring to is what we call non-mortgage debt. Meaning this. If I co-signed a loan for my son for a truck, right? And he's paying for the truck. He's driving around for it. He pays it. Comes out of his account. And I go to buy a house, right? Remember, my wife just left me for a young, thin, athletic guy. Doesn't want a fat, pudgy, bald hair, ugly-looking old man, okay? So she's off, and now I got my son, and I co-signed for a truck, okay? And now I want to go buy a house. I don't want to live in the same house that we lived in. I want my own little house, right? So I go and I try to qualify, but the loan is still in my name. I'm sorry, his truck payment is showing up. And I said, no. My son pays that truck. Well, if I can prove that my son pays the truck, that won't count against me because it's a $1,000 truck payment, right? He's buying a Raptor. Maybe it's a $1,500 truck payment. He wants to buy a Raptor. Okay, so that's non-mortgage debt. Mortgage debt is mortgage debt. Let's get into it. Now, just so you know, I am taking this directly from Fannie Mae's website. You can go right on Fannie Mae website and look at this just like me, okay? Matter of fact, instead of me putting it under the microscope, let me see if I can pull it up for us. Let me see if I can do that instead. Instead of putting me under the camera, let's do this. Let me pull it up. I'm going to pull it, and I'll show you what it is. So Fannie Mae, if you want to type along with me, Fannie Mae guidelines on monthly debt paid by others. Okay? That's all you got to type in. And what's going to pop up is B36-05. Okay? Monthly debt. I want monthly debt obligations. Okay? So look where I'm at. I'm going to pull this up, right? Pull this up. Okay? I'm right here. Fannie Mae's website. Monthly debt obligations. Okay? Now you're going to see here, right? Here's their monthly debt obligations. Now we want to go down to debts paid by others, right? Because remember, we just sold the house subject to financing to somebody else, to the guru. All right? Now, here we go. Debts paid by others. This is where we're at, right here, right? So I wonder if I can make this bigger. How do I make this bigger? Can I? I don't know how to. I'm sorry. I don't know how to. All right. So let's get into this. All right? Now, we're going to be right here first. Okay? And let me make this line a little bit thinner so I can underline it and show it to you. Okay? When a borrower is obligated on a non-mortgage debt, okay, truck payment, car payment, but is not the party who's actually repaying the debt. The lender may exclude the monthly payment from the borrower's recurring monthly obligations. Again, this is your debt to income ratio, okay? This policy applies whether or not the other party is obligated on debt, but is not applicable if the other party is an interested party to the subject transaction, such as the seller or the real estate agent. What that means is, hey, are they included on this deal? Because if they're included, we still got to add it. So no, my son's not included. So now you don't have to add it. Non-mortgage debts includes installment loans. That's like if you're buying, it's not a regular contract for deed. They're talking about if you buy furniture on like buy now, pay later, and you're making monthly payments. You buy a boat, that's an installment. A car is an actual installment loan. Okay? Student loans, revolving accounts, lease payments, alimony, child support, settlement maintenance. See below for treatment of payments due under federal income tax installment agreements. Okay? Now, so they're saying, hey, as long as they're not involved in the transaction, you can exclude it as long as they're not involved. So if they're not co-signing or on the loan, you're good to go. Now let's do the next one. Okay, because this is really important. When a borrower, this is a big word for 2 letters, is obligated on a mortgage debt, but is not the party making the actual repayment of the debt, the lender may exclude the full monthly housing payment from the borrower's recurring monthly obligations. Let's start from the bottom and work our way up. Number 1, the borrower is not using rental income to qualify. Meaning this, we're the guru, we got a property subject to, we're not giving the seller any rent from the rent that we're making. Okay? So is the seller getting any rental income? No? Okay, they're not using rental income? Check. That's good. Good to go. That's good. Okay, next one. There are no delinquencies in the last 12 months. Check. That's good. So far good. We can get it eliminated from our debt to income. However, the party, that's the guru, the party making the payments. This is a huge word for 2 letters. Is obligated on the mortgage debt. Okay, folks. Explain to me, this is right on Fannie Mae's website. By the way, look up Freddie Mac, look up any other ones you want to look up. Okay? Again, is obligated on the mortgage debt. Let me ask you something, folks. When did anybody who took it subject to, when did Pace Morley sign my wife's mortgage debt? Never did. Okay? When did you sign theirs mortgages? You didn't. Okay? If I got divorced, okay, and my wife wants to buy a new house with her young athletic stud, and I'm stuck here with my fat lonesome self, right? Well, she's not getting rent. She's good. There's no delinquency. She's good. But she is on the mortgage debt. Now, it sounds ass backwards. I agree with that. But she's on the debt. So now she doesn't have, it won't be excluded. She don't have to add this on her monthly debt. But is the guru on there? No, the guru's not on there. So any guru that says, oh yeah, I'll just show that I'm making the payments, dead wrong. Just go right to Fannie Mae's website and look at it again. I'll show it to you again. Right here. Okay? Here it is. Okay? It's this line right here. The party making the payments is obligated on the mortgage debt. Who's making the payments? The guru. The guru is making the payments. When did they ever sign the mortgage? They never signed the mortgage. They just took over the payments. So again, this subject to financing is really structured for divorcees, right? Or even like partners. It's not meant for gurus to try and do this silly stuff, okay? All this stuff happened way back in like the early 80s when interest rates were at like 18%, okay? So that if there was a house out there, and I'll just show it to you real quickly, but we're going to get into structure. But let me just show you originally why subject to was kind of around and how it was used. Okay, let me show you this. All right, this is kind of like how it was done. Let me erase this, and I'll show you what I'm talking about. So basically, this is kind of like what happened, right? So basically, you have the seller, okay. And we're going back now in days, okay? And here's the buyer. And this house got a fair market value of $100,000. The seller owes $80,000. He's selling, it's for sale for $100,000, right? Now the buyer wants to buy this house. However, when he goes to this bank, right, a 30-year fixed rate is 18%. If you don't believe the 18%, go back and look at your history and go look at the 80s, what the interest rates were, okay? 18%. It's like, shit, I can't do that. The seller says, listen, maybe we can work out a deal because I got to get out of here. And he says, look, here's what we can do. And he's a smart guy. He went to Vinny's school. He went to the Golden Triangle Academy, right? He said, look, now I don't recommend this program, but this is where it came from. By the way, back then there was no due on sale clause. This is why it came about. So here we go. So say, look, okay, Mr. Buyer, put $20,000 down. He says, I can do that. I was planning on doing that anyway. I was putting 20% down, okay? So now you put $20,000 down to the seller, and now you just take over this payment subject to financing, okay? So now the buyer can get this loan at 9% instead of 18%, and it's got 21 years left, okay? So now he's got a 21-year loan at 9% instead of a 30-year at 18%, okay? The seller gets out of the house, but that loan is still in their name, okay? So that's a problem, yes. But back then, there was no due on sale clause back then, okay? So he didn't have to worry about the note being called. He just had to worry about buying a new house. But he got out of it, okay? And to be honest with you, at 18%, nobody was really buying houses. But that's how subject to was really kind of structured. But the banks didn't like that because they weren't getting their interest rates. So now they threw that due on sale clause in there, okay? And they said, well, we're not going to have that anymore. And then they made it stringent. And if they find out, yeah, they're going to call the note due because they're losing money. They're not in the business of losing money, okay? So now, if you honestly think that you want to go try and do a subject to financing deal, but you don't know how to do it, you don't know how to structure it, just call me. Here's the deal that I'll make for you, okay? I'll do all the work for you. Now, I still think you should do something different, but if you're hell-bent on it, okay, and you have somebody who's interested in it, I will help you. No charge, free of charge. If the deal goes through, right, you split it with me 70-30. You take the 70, I take the 30, okay? Now, I wish you luck in trying to do it. I don't think it'll happen, especially without any money down. Now, if you're putting money down, it can happen. There's no doubt about that. People are desperate enough to do this if they get their equity. Because remember this, the only thing the seller has in the deal is their equity. That's all they have in it. They're selling their house to get the money and go. Other than that, they don't care, right? They just want to get out. So if you give them their equity, you can move on, right? So easy squeezy. You're just signing an agreement to sell, get them the money, right? Get title insurance, and you're on your way, right? With that, I wouldn't take anything from you. I'll just show you how to do it. I'll teach you how to do it. I'll walk you through the steps, but I'll help you along the way, okay? So if anybody's out there that wants to try this, okay, has somebody that's willing to do it, I will do it for free for you, no charge, okay? But if somehow, the seller wants to do this, which God forbid, I don't know why, okay, we split it 70-30. But again, there's a better method out there. I'm just not teaching it on this course here, okay? But there's better ways of doing things, okay, just to let you know. But that is the 30,000-foot overview of how this works and what's involved. Now, I didn't get into how to write the agreement of sale and all that and read the title. I didn't get into that. I know that. I'm just giving you like the basics, okay? The next video, we're going to talk about what the gurus talk about next, which is, the CYA letter and things of that nature. And boy, that's going to be a doozy. Then we're going to get into structure of the deal, the number game, okay? Because we got to do that as well. All right, so if you got any questions, feel free to put them down there. I'll try to answer anything. If you need me, the best way to always get a hold of me is by texting the word golden, GOLDEN, to 21,000, number of 21,000. So again, you text golden 21,000, you'll get a hold of me. Thanks for coming to the False Prophets Podcast. Good luck out there, everybody, and I'll see you in class.